Okay. So in the last week, we finished chapter 2. And in chapter 1 and chapter 2, we learned how to derive basic information from the financial statements and also how to use them properly. And basically, we learned fundamental financial ratios such as ROE, return on equity, profit margins, asset turnover, and equity multiplier. And relying on these ratios, we were able to evaluate a firm's performance both in the textbook and also in reality. So we take a closer look into Utsugi in Korea and also Netflix in the United States, so that actually we found that those ratios are very useful in reality. So if we were able to analyze those ratios, we were able to compare them historically, or if we compared them with their competitors, we were able to get some insights or some ideas whether we should invest in those firms or not. So that was the end of part 1 in our textbook, and from now on we are going to move to part 2. And in part 2 we are going to be an insider of a firm, and we are going to decide one of the most important decisions in the firm, whether should we need more money outside of the company or not. So in chapter 3 and 4, the big question we have is how much money do we need for our survival and the growth. And then in chapter 3, we are going to learn a way to measure or estimate the funds that are required for our survival. And in the next chapter, we will think about which source of funds should we use. Okay, so in chapter 3, because we want to estimate the future necessary funds, we are going to learn about first financial forecasting. So here the financial forecasting is to think about the future of the firm and to think about the money that we need for our firm. Okay, because this is essential to utilize those methods that we are going to learn in this chapter, on Wednesday, I'm going to show you, I'm going to present an example in the textbook using this computer, especially the Excel program. So if you want to follow me in the class on Wednesday, you can bring your laptop in the classroom so that you can just follow me what I'm doing here, okay? But we are going to do it on Wednesday, and today we are going to learn the basic principles, how to forecast a firm's future, and then we are going to apply it to the textbook case. So the first thing we are going to learn is pro forma statement. The pro forma financial statements are the financial statements. However, they are for the future. So it is a predicted version of the financial statements. For example, a firm's financial statements for the next year or the year after the next year. Okay? And do you have any question? Okay. And the main reason that we are going to write down the pro forma financial statement is because we want to estimate the future, especially in particularly about how much money we need and the money amount that we need, that we are going to call it as external funding needed or external funding required or required external funding. So those all terminologies have the same meaning, but for brevity, I'm just going to call it external funding needed, or shortly EFN. And it is possible to calculate the value for EFN if we construct the pro forma financial statements, because we are going to create the balance sheet in the future so that we can compare our predicted assets and predicted liabilities and predicted equity. So here's the idea. So because generally a firm grows as time goes by, maybe in the next year we will sell more. We will sell our products and services more to our customers, which means our sales will grow, and subsequently we need to have a larger asset in order to sell more. So shortly, we can say that a firm's growth can be represented as the growth in our assets or the growth in our sales. And then because the sale has increased, we need to support these assets by using our funds, and funds are represented by our liabilities and equity in the balance sheet. So by comparing the current level of liabilities and equity we have with the assets that we are going to need in the future, we can precisely calculate how much should we raise from outside. For example, we can borrow some money from the bank, or we can issue debt securities or equity securities. And then by using those securities, we can raise funds from outside investors. So EFN here is that should be obtained externally from outside investors to support the growth of a firm. And here we are using the term external, right? So why should we call it external funds? It means that on the other hand, we have internal funds, and the internal funds you have is cash generated by your operation. So we have internal funding, which we can say as retained earnings. So if you make some sales and if you make some net incomes, that means the value of your equity will become larger because you have gained retained earnings. By definition, retained earnings means the money that you are going to spend in the future. So those are funds that are available even though you do not get some money from the outside investors. So we have internal funds, but usually those internal fundings are not sufficiently large enough to cover the growth of the firm, so that we should raise additional funds from outside investors, and that is why we need external funding needed, EFN. So we now know the purpose of financial forecasting, and then how can we do that? The methodology commonly used in reality is called percent of sales approach. So as the name implies, percent of sales approach thinks all balance sheet and income statement items as proportional to sales. For example, you will think one item will be 86% of your sales, and you will think the other item will be 40% of your sales, so that you can estimate, you can calculate the future predicted values for each item. So the general regular procedure to use the percent of sale approach is following. First, you should distinguish every financial statement item, whether it can be proportional to your sales or not. So knowing the relationship is first thing you should do. So based on the historical data or based on your logic, you can make some assumptions whether each item will be proportional, which each item will be positively related to your sales or not. And generally speaking, you can distinguish those all items into two categories. First, there are statement items which are very relevant to your operating activities. For example, accounts receivable and accounts payable, those are highly related to your sales operation, so it will be very proportional to your sales. On the contrary, some other items are not that related to the sales, so you will not find any linear relationship between them. And then you have to make other assumptions to know the values for them. So we start by distinguishing operating incomes and operating expenses, and on the other hand, we can think about non-operating incomes and non-operating expenses, and then they are not going to be related to sales. And the second thing you should do is, now because you know the relationship between sales and each item, now you want to know about the future sales. So you need to forecast what will be your sales in the next year, or what will be your sales in the year after the next year. I don't want to say that you have to predict your sales only using financial approach, but you can rely on other methods such as lessons from marketing or lessons from strategy. So basically, forecasting about the sales is very related to your marketing skills and marketing techniques. So actually, many of the firms in reality start by predicting sales by using other approaches, and then they accept those values, and then they use those financial techniques that we are going to learn in this chapter. So you have to combine your financial techniques and other business techniques as well. And third step is, because in the first step you found out the relationship, the proportion of each items related to the sales, and now you know what will be your sales. So combining these two steps, in the third step you can forecast each item which are proportional to your sales. And the next step is to think about other items which are not related to your sales. And you can make several assumptions. For example, you can think that because this item has been on the same level for many years, I'm going to assume that this will be the same for the next year. Or you can think about, you can make some rough assumptions, or you can make linear projection, and maybe you can make other assumptions as well. But anyway, we are going to make several assumptions to think about the values for other items, and then finally we can complete our pro forma balance sheet and pro forma income statement. And after you finish writing down the balance sheet in the future, now you will be able to compare your predicted assets with predicted liabilities plus predicted equity. And then you will generally find that you need more money as the difference between them. So we are going to call it EFN. And finally, we have to choose the source of those funds. Should we raise money from equity market, stock market, or should we borrow the money from the bank? Right, so the basic principle is very simple, but more difficult, you apply it to the real situation. So today I'm going to use the textbook case about R&E Supplies and Suburban National Bank. So there are two firms, R&E Supplies. I'm just going to call it as R&E, and another bank. So R&E Supply has been a customer in the bank, and it approximately 5 years ago, it borrowed $50,000 from the bank, and it was paying back the money, and now it is time to renew the contract, whether the bank should allow the renewal of the loan or not. And suddenly, in this year, the representative, let me just call him CEO, the CEO of the firm came to the bank and asked whether the bank can lend a loan amount to $500,000. So it was a surprise news because previously they only borrowed $50,000, but now the amount has become 10 times. So they are trying to borrow $500,000. So in a shock, the loan officer in the bank asked why they need such a large amount of money, and they said they think that in the next year they are going to have a sales growth of 25%, and to have that higher amount of sales growth, they need to raise more money. So to win the competition between competitors and to develop, to invest in their new facilities and factories, they need a lot of money. So they are asking for this amount of money. And your question, the question we should answer is whether we should allow it or not as the loan officer in the bank. So because we learned several things to examine about a firm's performance, before we make additional analysis, we need to calculate the financial ratios of the firm so that we can have some ideas about the performance. And here is the financial statements for R&E, and we are using their financial statements information starting from 2014 to 2017. And here you can find the star here, 2017, and this is written as estimate here. So this is because we are assuming that we are in the year of 2017. So the year of 2017 has not finished yet. So say we are on September 2017. So we don't know what will be the precise value at the end of this year. However, we can make some guess. If things goes right, we will have such values. So we are going to call it as estimated value. So estimation is different from the prediction or forecasting. So estimation is about because we are on this year, we can make some guess, proper guess, but the forecasting is about the year after that. For example, we are going to forecast about the year of 2018. Okay, so that's the difference between estimate and the forecasting. Anyway, they provided some basic income statement information as well as balance sheet information. So for your convenience, I already calculated several financial ratios for the company, and here are the results. So in 2014, ROE was more than 30%. However, in 2015, it became 28, in 2016, 24, and in this year, in 2017, it will be only 17%. So it seems that the firm has some problem, and I decompose the ratio into several parts. So we learned that ROE can be decomposed into the multiplication between ROA and the equity multiplier. So I have ROA and equity multiplier. And also ROA can be further decomposed into profit margin and asset turnover. So we have profit margin times asset turnover times equity multiplier, which is equivalent to ROE. And as you can see, ROE is decreasing and profit margin is decreasing. And I like to be sure, to be confident. So I also calculate the ROIC. So as a reminder, let me go back to the income statement and let me explain how I calculate the ROIC for this firm. So I start from earnings before tax. So the ROIC is a measure which is aside from its capital structure. So we are going to assume that the firm has no interest-bearing liabilities. So therefore, they don't need to pay the net interest expense. So net interest expense means the firm is paying some money to the debt holders, but now we are assuming in the calculation of the ROIC, we are assuming that there is no interest payment. So we add back $100 to earnings before tax to calculate EBIT, earnings before interest and taxes. And then from that point, we recalculate the tax expense we should pay. And because the firm is paying 302 among 671, and because the firm is paying 325 among 723, it gives you a knowledge about the tax rate. So the tax rate, if you calculate, the tax rate will be 45% approximately. So I'm going to use this 45% as a tax rate to calculate the tax expense under the assumption of the ROIC. And then if you take out the tax, then you get a new earnings after tax, which will be your numerator in the calculation of the ROIC. And in the denominator for ROIC, you have to select interest-bearing liabilities and owner's equity or shareholders' equity. So shareholders' equities are simple. Shareholders' equities are here, these two terms. Common stock, which was given when they issued their shares, and their retained earnings, what they have been earned from the beginning of the firm. So these two will be their equity. And on the contrary, you have to ignore some liability items which are not related to the investments. So they are accounts payable and accrued wages. So bank loans are your invested capital, so you have to include it in the calculation of ROIC. And current portion of long-term debt, it means if you have this amount of long-term debt, and then now because your maturity comes soon, you have to pay back some of the money, and that will be called as current portion of long-term debt. So this is also a part of interest-bearing liabilities. But on the other hand, accounts payable, they are presented in the balance sheet because you are selling and you are producing some products and you didn't pay the cash yet. So this is related to your operation rather than financing So we are going to ignore it in the calculation of ROIC. And also accrued wages, these are the money that you have to pay for your employees. However, unfortunately, you didn't pay yet, or you had some intention to pay them later. For example, you are preparing their pension, for example. In that case, you have accrued wages. So accrued wages are also not a financing source, but it is related to your operation. So you have to remove accounts payable and accrued wages in the calculation of the ROIC. And then the remainder are bank loans, current portion of long-term debt, and common stock retained earnings. And if you add them up, you will calculate the invested capital. And that will be your denominator for ROIC. And then you can get these numbers. So you can try it at home. The ROIC in 2014 was approximately 90%, and now it becomes only 13% this year. So as you can see, not only the ROE or ROA and profit margin, but also ROIC is decreasing. So there are some problems in the operation of the firm. And as a loan officer for the bank, you will be concerned about the performance. So you ask again, what did you say? Where are you going to use those money if we borrow it, if we accept your request? And because the CEO of the firm responded that they are going to spend it in capital expenditure, they're going to use to purchase additional fixed asset. So we are now going to use the percent of sales approach to make pro forma statements. So we start by selecting some financial items which are proportional to sales. So if we go back to the income statement, we have several items such as cost of goods sold and general selling and administrative expenses, net interest expense, and tax. So first, think about the cost of goods sold. So if you sell products more, then you have to produce them more. So there will be a higher cost of goods sold. So therefore, we can guess that there will be a linear relationship between sales and the cost of goods sold. And the second thing is general selling and administrative expenses. I often write it selling, general, and administrative of expenses. So I often shorten it by calling it as SG&A. And this is about the marketing expenses, and this is about the management expenses related to your operation. So by definition, it is highly related to your sales, and we can make a simple assumption that these SG&A, selling, general, and administrative expenses will be also proportional to the sales. And the third item we can find is interest expense. However, interest expense is not proportional to sales. Rather, it is more closely related to the liabilities you have. So therefore, we are not going to assume that there is a linear relationship between interest expense and sales, but rather we are going to assume that we have to pay certain amount of money in the next year. And finally, we have tax expenses. And again, tax expenses are calculated based on your tax rate, not just by sales. So you don't pay more if you sell more, but if you do not have such income. So you have to pay to the government only when you produce your profit, not just because you sold some of your products. So tax itself is not directly related to the sales. So we cannot calculate the tax by based on the amount of sales. And then we have two items in the income statements which should be highly correlated to the sales. They are cost of goods sold and selling, general, and administrative expenses. And then how do I get those numbers, the percentages? If we go further, we can find table 3.2. And here it gives you an information about certain items relative to the sales. So here you can find the cost of goods sold, and its percentage of in terms of sales has been 84%, 85%, 85, and 86 for the last 4 years. Therefore, we assume that in the next year, it will again become 86% of the sale. Next, we have SG&A, and also it's been 9% of sales in 2014, 9% of sales in 2015, 10% in 2016, and 11% in 2017, this year. So we can assume that because there is a slight increase in the ratio, we are going to assume that in the next year, when the year in 2018, the ratio, the percentage will become 12%. So that is why I choose 86% for the cost of goods sold and 12% for these administrative expenses. And there were items which are not proportional to sales, such as net interest expenses and taxes, and we are going to make several assumptions to get the values for them later. Okay, and we move to the balance sheet. And let's first take a look at the asset side. So again, we have multiple asset items, cash and securities. So the first thing appears here in the balance sheet has more liquidity, and later it has less liquidity. So generally, the first item you will observe from the balance sheet is cash and cash equivalents, and here it is written as cash and securities. So cash will be generated if you sell your products or your services. Therefore, the amount of cash you have will be related to your sales. And also, accounts receivable is the promise that you are going to get the money later if you have sold certain amount of your products. So therefore, accounts receivable is also related to the sales. And similarly, inventories are related because if you want to sell more, you have to prepare more. So you need to have a larger inventories in your firm if you want to increase your sales. So these are three items: cash, accounts receivable, and inventories. They are all related to the sales. And because of it, we are going to assume that these three are really proportional to the level of your sales. And the fourth item you have is prepaid expenses. The prepaid expenses are the money that you have to pay, but not this time. You have to pay those money later, but eventually you paid it first, so that in the future you don't have to pay certain amount of money to other stakeholders. So this is not related to your sales. So the prepaid expenses are something like this. So I often go to a laundry shop to clean my shirt, and in my town I have to pay 4,000 Korean won for each shirt I gave them. But one day I had 5,000 Korean won bill, but I didn't have precisely 4,000 Korean won in my pocket, and then I give the owner of the laundry shop 5,000 Korean won at once, but I didn't receive 1,000 Korean won back. In that case, I can if I go to the shop again in the next week, I don't have to pay 4,000 Korean won, but I can just only pay 3,000 Korean won. So that's the concept of prepaid expenses. So you have benefits in the future, and when you have benefits in the future, you can call it as assets. So that's why prepaid expenses are listed in the asset side. And anyway, these prepaid expenses are not that related to your sales, but for many reasons it can happen. So we are just going to make an assumption that prepaid expenses will be very similar to the historical level. So if I look at those historical level, prepaid expenses has been 14, 12, 15, and 18. So it was between 10 and 20. So I'm just going to assume that in the next year, prepaid expense will be 20. And the last item in the asset side is net fixed asset. And this is related to your facilities, factories, and your properties. So it is also not related to the sales itself. For example, if you have sales of 100% this year, but if you get a double sales amount in the next year, then maybe you have to install another factory so that you can make more production. However, if it does not increase that much, then you don't have to buy another factory. You can just use your current factories, but you are going to use it more often. So when your sales increase, it does not always mean that you have to increase your fixed assets. Rather, it is more related to your investing decisions, whether you borrow, whether you purchase additional fixed assets or not. So that is called as capital expenditure. So if we know the information about the capital expenditure and the depreciation, and then you can calculate the fixed asset. So I'm not going to assume that fixed assets are proportional to sales. I'm just going to calculate it based on the capital expenditure of the firm. And we have liabilities and equity side. And bank loans. This is the final thing that we want to know about the case. So it depends on whether the loan officer accepts the request or not. So I'm just going to ignore this bank loan this time. And we have accounts payable. So similarly to accounts receivable, it happens during your operation. So accounts payable are also proportional to the sales. But on the other hand, other items are not that related to your sales. For example, long-term debt will occur when you borrow more from debt holders. Accrued wages, will be in the similar level if you do not hire additional employees. And common stocks, if you do not issue additional shares, then the common stock will be the same. So therefore, all other items are not related to your sales. So we are going to ignore them first. And then the balance sheet items which are proportional to sales are cash and securities, accounts receivable, inventories, and accounts payable. So these 4 items will be estimated by the percentage of sales approach. And the other items are not proportional to sales, so we are going to make several assumptions, such as considering them as constant or calculating them depending on the capital expenditure and so on. And I have selected those numbers in order to get the same conclusion as the textbook. So you don't have to do it when you actually solve a problem, but I just wanted to show you the same result as the textbook figure, so that's why I chose those numbers. And those numbers was obtained from the historical data, but the reason that they are different in this table and the previous slide is because they are in different measures. For example, cash and securities, the textbook measures them as days sales in cash, which we didn't learn in this class. So I just wanted to simplify it. So I just calculated as a percentage of sales, and I obtained 4.933%. However, it has the same meaning as the textbook, so you don't have to feel difficult about the days sales in cash, collection period, and payables period. You can just ignore them. Anyway, now we know the ratios. Now we know the percentages of the sales, and then we can start from the income statement. So the pro forma income statement will start from the sales, and because in 2017 the sales was 2,613, and because the firm is believing that the firm will have a 25% increase in its sale, we can calculate its predicted sales in 2018 as 25,766. And then based on this number, 25,666, we are going to use the percentages that we have obtained to get the values for other items. So, for example, because cost of goods sold was 86% of each sale, we are going to multiply 0.86 to the sale, and then we obtain 22,159. And then the difference between them will be gross profit, and we have selling, general, and administrative expenses, which amount to 12% of the sales. So we again multiply sales times 0.12, and we get 3,092. And then the next item we have to calculate is net interest expense. And because it is not proportional to sales, we have to make some assumptions. But I'm just going to think it as a constant. So here in the last year, in this year, in 2017, we are paying $90 of net interest expense. So I'm just going to use the same number, 90, here. So this is my assumption. And you can have other assumptions when you actually solve those kind of problems in reality. However, you need to make proper assumptions based on some criteria. Anyway, and then we get the earnings before tax of 425. And because the tax rate is 45%, the government will get $191 out of 425, and then what we remain is 234. So this will be the net income in the year of 2018, in the next year. So now we have finished pro forma income statement, and then we move on to the balance sheet. First, think about the asset items. Cash, accounts receivable, inventories, these three are proportional to sales. So again, by using the predicted sales, we are going to use those percentages to get the values in the pro forma. And we have 1,271, 3,000, and 2,000 approximately. And then the fourth item was prepaid expenses, which are not proportional. So we have to make some guess. And I have told you that I'm going to assume that I'm going to use 20 as the value for prepaid expense. And then now we have current assets, but last thing we have to think about is fixed asset. So in the last year, the net fixed asset was 287. The net fixed asset was 287, and it will be the net fixed asset beginning of the year of 2018. And during that year, we are going to purchase additional fixed asset, what we call capital expenditure, and then we are going to deduct some values out of it because we have depreciation. So therefore, by applying capital expenditure and depreciation, we can calculate the fixed asset at the end of this year. And according to the CEO, they are going to invest $43,000 to the purchase of the fixed asset. So the capital expenditure will be 43, and they usually depreciate $50,000 per year. So I'm going to use that number. So anyway, we get the net fixed asset as 280. And as a result, we have the predicted total assets of 7,633. Okay, and we go to the liabilities and equity side. Because we have paid back all the existing bank loan that was previously in our contract, we have no bank loan anymore, but we are asking about getting additional bank loan, renewed one. And so we are going to assume that currently there is no bank loan. And accounts payable was proportional to sales. So by using this percentage, I get the number. And the current portion of long-term debt is the amount of debt that I have to pay back this year, and it was $100 in 2017. So I'm just going to assume that it will be the same for the next year. So I write down 100 here. And again, accrued wages are not proportional to sales, but I'm going to assume roughly that it will be 22 in the next year. And then I get current liabilities. And because I had long-term debt of 760 in the last year, but this year, in the next year, I'm going to pay back $100 among it. So I have to get rid of 100, and the remainder will be 660. And because I have no plan to issue additional share, the common stock will be the same as 150. Finally, there are retained earnings. So the retained earnings is calculated based on the previous retained earning. And the last retained earnings was $1,580,000. But now, during this year, the year of 2018, because the firm gained some cash, gained some net income, as much as $234, it will be added to your retained earning at the end of 2018. However, there is also a cash outflows. This firm is paying dividends. Among the net income, they are paying 50% of the money to their shareholders. Therefore, you have to consider the dividends as well. And you start from 1,580 and you obtain 234 as a net income, and then you pay half of the money to your shareholders as dividends. Then you get a retained earnings of 1,697. And therefore, if you add them up, then you get total liabilities and equity 6,211. But here comes the problem. So in the last slide, the total asset predicted value for total assets was 7,600 approximately. However, now you only have $6,200 approximately. So there is a $1,400 difference between these two. And it does not, in this relationship, we cannot observe a proper relationship between assets, liabilities, and equity. According to accounting principle, we should always find assets as the same as the sum of liabilities and equity. So liabilities and equities are the sources of your fund. On the contrary, assets are backed by those sources of the fund. Therefore, you have to make sure that each of them match the other. However, there's a difference, so we are going to call it as external funding needed, EFN. So we need to raise additional this amount of money outside of the firm. Of course, you can obtain some funds internally, and that is represented here, retained earnings. So you gained net income, and even if you pay to your shareholders, you left with $167. So that is the internal funding that you can have this year. However, it is not sufficient for you for this firm. So as a result, the firm needs additional $1,422 outside the firm, and one choice was the bank. So in conclusion, R&E needs external funding of $1,422 because this number was in dollar in thousand. So therefore, even if the loan officer accept the request and give the CEO $500,000, it is not enough for the firm to have such pro forma realized in the future. So this is because the firm is expecting to grow 25%, and then because the sales grows as much as 25%, assets will grow similarly, but you don't have such money to support the increase in the asset. Therefore, you need a large amount of money outside of the firm, and the bank loan is not sufficient for the firm. Therefore, before moving on, the problem will become even worse if we think about those things. So in our analysis, when we were trying to have those pro forma balance sheet, we assumed that the net interest expense will be the same, right? It will be the same as the last year's expense, 90. However, if we borrow those huge amount of money from the bank or someone else, and then we would pay a lot of interest, and the net interest expense will become larger and larger. So if interest expense become higher, and you have lower earnings before tax, and you have lower earnings after tax, which is the net income predicted. So the net income will be reduced. And then in the pro forma balance sheet, you had this amount of retained earnings because you had that amount of net income. But it becomes lower. So the retained earning becomes lower. And the total in liabilities and equity become lower. And then the gap, the difference between the asset and liabilities plus equity will become higher. So you need more external funding needed. So as a result, if we consider that we would pay the interest expenses by borrowing from the bank, then we will have a lower net income, and consequently we will have a lower internal funding. Finally, we need more external funding. So it is an irony because we borrowed such huge amount of money to support the growth of the firm, but actually it results in paying more to outsiders. And therefore, the conclusion here that the loan officer make is that the bank will reject the offer. So the loan application will be rejected by the bank, and also R&E itself has to think about their management, whether they are doing good or not. And because now it was found that their 25% is an impossible goal, they have to adjust their management goals. For example, they can set or they can target a lower growth rate, such as 20 or 15%. And also, they can also think about the reasons of those problems. So the reasons that they need external funding is because they are not generating money enough. So not generating money equals not generating enough cash. So they have to think about their cash collection procedure. So they have to tighten up their collection of accounts receivable, for example, and they can get more cash so that they can use them to invest more in the fixed asset. And in a similar vein, but in the opposite way, they have to delay. They should avoid paying cash to others, so they have to settle for the extension of accounts receivable. So not only for the bank, but also for the company itself, this percent of sales approach and the created pro forma statements are very useful about thinking about their management.